When you buy an income producing asset, is there a specific number that at least you want as far as that delta between what the actual current rents go for and what your note goes for? Or are you buying it all cash? I hope you're not buying cash with where interest rates are.
No, I've actually went back to assets and took cash out. So no, if I can borrow at 4%, and earn more. So I don't think about it as a rent number. For me, it all comes down to how hard my money's working. I call it yield, right? I treat every asset like a bond. It's just how my brain works. Some people call it cash on cash. But for me, that's what it is, right? And I've used the same spreadsheet to compare little houses with big apartments. I want to know how hard my money was working. I think there's, again, lots of rules of thumb out there that are just wrong, like bigger is better. Well, bigger is better sometimes. Bigger is not always better. Sometimes it is, sometimes it isn't. And, I want to know how hard my money's working. So today, I just borrowed 4% on some buildings that I own free and clear because I expect to earn north of 8%. I want to get double the rate of capital, cost of capital. So that's what I look for is double the cost of capital.
That's brilliant. And so when you look at some of these real estate investments that are currently producing that income, you mentioned you want to determine yield. Ultimately, you're figuring out how much of invested capital that it took, and then you're, really, well, the other way around, dividing the cash flow of that property and dividing it by the total amount invested.
Yeah, it's really a simple math. This is a numbers channel, right? The denominator or the bottom number is down payment, closing cost, and make ready. This is something I did wrong in the beginning is I bought junk and didn't include make ready, right? Which is fixing up all of that. So all of that's the denominator, right? How much money comes out of my bank account to buy that asset and control it and make it rent ready? And then the top number is simply monthly true cash flow times 12, right? Produces a yearly number, do the math, convert to a percentage, and you're there. So yeah, it's that's all it is. And every market has their average. This is the problem, back to Tom's point about people going to D-class areas in Ohio or Michigan or wherever it is. You can go broke buying cheap. Excel lies. So I tell people you need to spend 60 or 90 days learning your buy box. You need to only answer one question, and that is what's an average deal. Once you spend 60 or 70 or 80 or 90 days, whatever it takes in your buy box, your only job going forward is to do good or great deals. If average is 6, go do 8 or 9. If average is 10, go do 11 and 12. There are so many properties on the market. You don't bother doing average. Average sucks. Spend the time, find the 1 or 2 great deals, and get going. So that's what I talk about and teach all the time.
Recently I had an income producing property that was cash flowing quite nicely. In fact, the cash on cash was over 20%. Okay. Granted, I've owned this asset for a long time. It naturally makes sense. You're probably not, I recently did a further evaluation on what it would cost a new investor, and that number was closer to 8%, which makes sense. But just because of my acquisition cost was very low. But at what point do you actually want to say, you know what? Let me do some calculations of potentially disposing of this asset and looking at the next opportunity. At what point do you decide to sell? So I recently did that. For me, it was one of those deals where, if I sell, I could take that existing free cash that I'm going to get from this deal, and I can deploy it at a higher velocity from what I'm getting today.
Yeah, I think that's an interesting way to look at it. Everybody can do their thing. That's not how I would look at it. So I think there's a couple of things, and I've done them both, right? I've sold /1031. That's the same thing. And I've done cash out refinances on assets with low basis and actually free and clear. So there's a couple of things. The most important thing for me is, will it be a better return, right? Is it going to be meaningfully different? If the asset I own, for example, is earning 8 and I think I can get 10, that's not meaningfully different. Because 8 is certain, or at least as certain as it can be, and 10 is living in Excel. You just don't know what surprises can happen. Now, if it was 16%, that might be interesting, right? It's like, okay, 16, maybe it's 12, it's meaningful. What I actually do when I decide to sell is I don't think about those numbers at all. What I really think about is the asset I currently own, is somebody going to overpay? So like I wrote in my book, One Rental at a Time, I was trying to buy that 9th house. Let's go through the details. The first house I bought, Norris Drive, bought for 107, rented for 1,100. Cash flowed fine, right? Especially with 20% down. Lo and behold, 3.5 years later, that same house on the same street is selling for $265. Unfortunately, it still rents for $1,100. No bueno, no good, right? So I can't buy anything. So now things are unaffordable, right? The unaffordability or the affordability index is crashing in my market. So I sell every house, or 1031 every house. Now go back to 2019, something different. Bigger is better is all the rage. And Grant Cardone has everybody looking at apartments. I happen to own a C-class of building that I bought or I 1031 into. I had lots of equity. It needed about 20% of the purchase price in immediate investment. It was a Section 8 C-class building. It was a headache to manage. It was still cash flowing because of my basis. I was fine. But somebody wanted to overpay for that because bigger is better. They got a bunch of friends together and they overpaid. So I sold, and I actually sold. I didn't 1031 because I couldn't find anywhere to put my money. I paid the IRS. It's okay, right? It's fine, right? You don't go broke taking profit. I would have loved to 1031, but I'm not going to do a bad deal. So that's kind of how I think when to sell. I'm really a buy and hold forever, but if you want to overpay for anything I own, you could take it.
It's hard to do a 1031 in stocks.
Yeah.
I wish. I mean, you can write off losses that you didn't foresee to offset gains, but there's no sort of tax vehicle like that. So
there's a reason why your podcast and your book is called One Rental at a Time, right? And so it totally makes sense.